Canberra for Canada's Mortgage Minute on Wednesday, January 23rd. Hey, just a quick conversation. I thought I'd share some thoughts with you about Canadian mortgage rates and how much they hinge on the Americans. Now, if you want to know where our mortgage rates are headed and what's going on, just watch the American news. The reason is because Canadian bonds are 95% correlated with American bonds, the treasuries, and bond yields are 97% correlated with the 5-year fixed mortgage rates. In other words, Canadian rates are married to U.S. rates. So it's no wonder that our mortgage rates are being shifted by things like, well, all kinds of things that have been happening in the U.S. recently. The debt ceiling, the fiscal cliff, all these things that they were talking about before. So let's talk about some of the factors that are weighing on our rates. Rates are basically caught in a tug-of-war between bullish factors, those are things that lift up yields, and bearish factors, those are things that depress yields. So let's look at a little summary of each. So, bullish factors for rates. Cliff relief. Well, obviously, as you know, the U.S. dodged a full, basically a swan dive off the fiscal cliff. Now, I got my own thoughts on the fiscal cliff thing, and I think how over-created and overhyped it is. But that's a whole different mortgage minute and a whole different conversation. As a result of the resolution, what's happened is traders have been selling off safe bonds and rotating them into riskier assets. And if debt ceiling talks progress better than expected, there will be more of that to come. Now, in the spring market, bond and real estate seasonally are sometimes underestimated. And again, especially in the U.S. market, which has been depressed for so many years, and it might have a bit of a liftoff. And prime home buying season approaches, fixed rate mortgage demand could help support some yields. Now, the bearish factors are a U.S. Basically econo flip-flop, or flop, basically. As Congress's new tax increases are basically what are they going to do to job and growth? As we know, there was some opportunity there, and there was some not some consensus, so there is going to be some new tax increases. And the wasted opportunity that they missed out on with all of this was to cut spending, and obviously there hasn't been much spending cuts at all, and the U.S. austerity measures in the future could be more severe. But again, a lot remains to be seen. The debt ceiling, in a few months, Congress again is going to face another big decision, whether to raise the debt ceiling for the 41st time in 30 years or let the U.S. default. Again, this is a misnomer here. The U.S. doesn't start shutting down and they don't default. There's still payments and things that are done. A lot of these programs are extra programs that are pet projects of different politicians. And again, you have to understand the U.S. mechanisms a lot more to get that. But a lot of it is, in my opinion, created and basically a high drama. The latter isn't likely, but the thought of it could obviously perpetuate a safe haven trade. Again, people, it's going to keep people from dumping bonds and driving up yields. The euro risk, obviously, as we know, the Europe's 3-year debt turmoil has been basically ongoing, and the odd time it's been upstaged by the U.S. But there's still lots of issues in the U.S. I mean, you've got, in the European Union, you got Spain, you got Greece. Facing depression, all kinds of different things. Now, wild rates for cards are things like rating agencies. As you know, Standard & Poor's and all these different kinds of rating agencies have an impact on what happens with rates. Credit agencies obviously were shaking their head after the last, going around with the budget tightening and when nothing actually got tightened. So that could obviously impact the AAA rating that the Treasury has got, and it could obviously have some real, an impact on what's going to happen with yields going forward and what the U.S. Treasury is going to do in exchange for that. There's also the U.S. and or Canadian outperformance. Most traders expect low rates to stick around, but if employment numbers significantly improve and traders sense that the Fed is abandoning its commitment to hold down rates in the U.S., all bets are off. I mean, the historic Treasuries rally will unwind and basically we'll see yields lift off. So at the moment there is basically maximum uncertainty. You can basically watch any show, any procrastinator, anybody who's out there who's telling you what the future is going to hold is going to tell you that, oh, it could go this way, it could go that way. Bottom line is nobody really knows for sure, and there is a lot of uncertainty. Now, nobody is expecting, me included, any major increases in the short term or anything dramatic or spiking, but I definitely think in the near term we will see some slight increase, maybe a quarter point or so. So at the end of the day, what does this mean long term? Hey, your guess is as good as mine. I would say that in the near term, again, like I said, we're going to see some slight bump up. In the long run, we might see today's epic rates finally fall by the wayside. We are at historic lows, record lows. We keep talking about it over and over, and there's been lots of factors that have been keeping them there. As I shared with you today, the U.S. is a big one for us. Where they will go in the future, hey, anybody's guess, but if you look at any kind of pendulum, it swings one way and then back the other. And we are extremely this way for low rates. At some point, we're going to see the swing back. The question is, where will you be at that time? Again, what I'm seeing with a lot of our clients is they're taking 5-year rates. 10-year rates under 4% right now as well. Ridiculous rates. So there's a lot of security if you do want to take long-term rates. There's obviously some short-term options with some variable rates. There's all kinds of stuff. Anyway, to navigate through this, if you need help with this, give us a call at the Auxilium team. It's been Cam, the Mortgage Man. We're always here and happy to help, and I look forward to talking to you tomorrow.